We will start at noon.
Yes.
Sounds good. All right, it looks like it's 12 o'clock and we've got a bunch of people in attendance, so let's get this started. All right, thank you for joining us today. If you're here today, this is the second presentation in our 6th webinar series titled Show Me the Money. I'm Ashley Hartman. During his 38-year career as a financial executive and small business owner, Henry McCabe gained deep knowledge of how enterprises operate and how their operations can be represented in financial models. Henry has been a SCORE mentor since 2003.
And I'm Henry McCabe. Ashley has been a SCORE mentor since 2019. She's an entrepreneur and business owner, specializing in e-commerce business with a focus on business marketing strategy. She enjoys working with startup businesses, and we're happy to have her with us today and as a mentor in SCORE.
Great, we have a lot to cover today, so let's get started with some webinar housekeeping. All attendees' microphones are muted, and we will answer questions at the end of the presentation. You will need to enter them using the Q&A tool, but feel free to use it at any time as we go along. The presentation is being recorded, and if you experience any internet issues, you can always call and listen to the presentation via phone. All right, to get started, like many business owners, you may be asking yourself, what now? The goal of this webinar is to make you aware of ways that you can forecast your business financials to help discover if there is a way out of the economic crisis we are in. Specifically, ways to help you understand the numbers and tools to manage your business finances. The topic of money sounds exciting, but prepare yourself. Managing finances requires time and patience to delve into the numbers. And today we're going to take you through a step-by-step sample process to do just that. We're going to use the numbers from a made-up company to illustrate the process. Our fictitious business, ABC Company, is a 4-year-old clothing store owned by Bob Jones. If you own a retail store, you might be thinking, great, this applies to me. But this is just a sample business, and we could have chosen a different type of business, perhaps the kind of business you run. Remember, when it comes to business finances, all companies are the same. Money comes in, money goes out, and the owner hopes there's some left at the end. The coming and going of business financials all boils down to numbers. And how do you find these numbers? You already have them. They're in your monthly financial statements, tax returns, and bank and credit card statements. However, the difficult part of using your business numbers to see patterns or predict future results. No, let me try that again. However, the difficult part is using these business numbers to predict your future results for your business finances. We're going to show you how to use spreadsheets with programs like Excel to help you analyze your numbers and predict future results. So if you currently own a business, you are likely to be dealing with the impact of COVID-19, either shutting down or negatively impacting your ability to do business. Like you, things have been going along pretty well for ABC Company until COVID-19 hit. Perhaps your monthly sales numbers look a lot like this chart. And like Bob, you may now be thinking, can I survive this? Do I shut down for good? Should I keep going? And even if I can survive and stay in business, will I be able to thrive sooner or later? These are complicated questions, often driven by emotion, especially fear. But don't panic. Use your numbers to make informed decisions about what is best for your business. The numbers can help you make a decision about closing your business or staying open. And if you feel you can stay open and survive, the numbers can help you identify ways to thrive in the future. So now we're going to dive into finding your numbers, understanding your numbers, evaluating your numbers, and projecting future numbers. So if you're here looking for solutions outside of business finances, maybe marketing, you're in the wrong place. Our future webinars are going to be addressing these type of solutions, but today we're going to address numbers and business financials. I'll turn it over to Bill, our expert in the numbers.
I go by Henry in this.
Oh, but, sorry. Thanks.
Bob talked to a mentor with SCORE who suggested that he organize his business financial numbers in spreadsheets because that way he can look at them, he can discern patterns, and he can manipulate them, and he can use them to generate future forecasts of the future impact of various changes to his business. You could look at this by taking your financial statements, your monthly financial statements, if you have them, your bank records, or whatever, and flip back and forth between them all looking for these kind of patterns. But it's very difficult to do that way. By putting them in spreadsheets, you can see how the numbers interrelate with one another. And as you will see, as we get into the later, they become the basis for doing a financial forecast. Bob started with an empty Microsoft Excel workbook like this. He began by entering numbers. And we're going to show you those numbers. And there's a lot of numbers. And what we want you to do is pay attention to the process that Imaginary Bob used rather than the specific numbers. Don't try to sit there and analyze the numbers. It's more about process rather than the specific numbers. If there's something in the numbers that we need to point out so that help you understand the process, we will do that as it occurs. Using Microsoft Excel, Bob started by summarizing his income statement for the 4 years that he's been open, 2016 through 2019. This is what the thing looks like, except for it had to be compressed in order to fit the slide. The line item third from the bottom, all other expenses, actually had 10 or 12 accounts in his accounting records. But you can see on this slide one thing right away. You can see the patterns. You can see what's happened to the business. If you look at the revenue at the top, you can see a pattern of growth. If you look vertically up and down the column, you can see what's impacting the profit and loss. Organizing the numbers in this way is a very useful tool rather than flipping through piles of paper. Now, a lot of people are not familiar with Microsoft Excel, so I suggest to you that you reach out for assistance if you're not familiar with this process. A score mentor can help you, your accountant can help you, perhaps you have a friend or family member that can help you. But put the numbers together and then you can see what you're looking at. If you don't have monthly financial statements to draw records from, then you have to create them from the details in your bank account statements and so on. It's more difficult, but I hope you'll see that it's worth the effort. A couple of minutes ago, I just said that you didn't need to pay attention to all the numbers, but I want to make a point about the numbers. I don't know if you noticed on the first slide that the net profit fell significantly from 2014. That's the bottom line in this chart. From 2017, it dropped from $73,000 down to $26,000. That's one of the things you see when you look at this. And the reason for that is in the payroll number up above, because you can see the pattern there. The payroll has gone up substantially from 2017 to 2019. Not a good thing, right? Profit dropped and the payroll went up. Well, actually, in this case, it is a good thing because most of the payroll was Bob paying himself. This is a subchapter S corporation, and he can take a salary from the company. And he did that because, after all, the reason he has a business is so that he can get some money out of it. The point of this is that by scanning across numbers at the bottom or at the top, you can see patterns of what's happened. For example, the facility cost barely changed, only by a few $1,000s. The advertising expenses barely changed, only by maybe $1,000 or $2,000. It's easy to see those patterns when you're looking at numbers in this way. In addition to the monthly, the income statement by year, Bob also summarized his balance sheet in a spreadsheet. The balance sheet shows the assets, which are the things the company owns, in this case, cash, inventory, other current assets. We don't have to get into detail about that, but there are other assets, and net fixed assets, which are the physical objects that the business owns minus depreciation. And it shows the liabilities, which are the monies that are owed, current liabilities that are payable in the near term, and long-term liabilities, which in this case are a loan to the business. And the bottom, the capital investment and the retained earnings over the years. So now he has this batch of data. One thing you can notice if you scan across is the impact inventory has. Inventory is his largest asset. And you can notice that it went up substantially from 2017 to 2018 and fell again in 2019, a pattern. Why? Why did that happen? We can get into that. But the most important statement yet, because everybody looks at the income statement and the balance sheet, but the most important statement to a small business is this one. Bob summarized, or he calculated a cash flow statement using his income statement and his balance sheet. And this gives him a high-level overview of the coming and going of cash in the business. And in fact, for we small business owners, cash flow is where it's at. And cash flow is significantly affected by other things than the income statement. On this sheet, net cash flow from operations is the result of the operations reflected in the income statement. But in this case, also this business's cash flow has been affected by investments in inventory, other working capital, and investments. And the investments in this case are physical assets, $51,000 when he took over and fitted out the rented space. And you'll notice in 2019, he spent another pile of money, which was fitting out the back room of his operation. So you can look at a sheet like this and say, aha, I never thought about it this way, but this is a summary of where the money has been coming and going. And it's also very nice to see that coming into the COVID-19 crisis, he had over $80,000 in the bank, a very comfortable number. He didn't intend it that way. He was saving up so he could refurbish the front of his store to fit the kind of customers he learned over the 4 years that were coming into his store. In addition to doing the annual ones, Bob also summarized his last year's numbers, 2019, by month. It's the income statement. I chopped out the middle between the April to September numbers to make it fit the screen, but this shows the income statement by month. We are going to use this later, you will see. But for the moment, you can look at this and you can see patterns, for example. If you look at the payroll, you see that it basically went up in somewhere between March and October. Bob reflects on that now and says, oh, that's when I hired another person, or actually a part-time person, so that I could go home at 5 o'clock at night and leave somebody to run the store for another hour. So he put those together by month for his income statement, and the same thing for the balance sheet, showing the assets, the liabilities, and the capital invested going across. Looking at the inventory, we already saw this on the monthly summary. His inventory fell from 132,000 at December, that's what the balance forward is, December of the prior year, to $120,000. Why did this happen? Well, Bob got nervous in 2018 about the amount of money tied up his inventory. He was really making his inventory buying decisions off the top of his head. A vendor would say, this silk shirt is going to sell like hotcakes to the upper class men that come into your store. Oh, okay, I'll take 200 of them. He wasn't really thinking about what the future, would he be able to sell those things? But he got nervous, and he rightly so, as we'll see. So now he has that, 2 documents, and from that, he can do a cash flow spreadsheet by month for the year. Coming back to the fact that it's the coming and going of cash that's the important, and you have to pay attention. I find that many small businesses look at the income statement, and they look at the balance sheet, and they don't mean a lot to them. And what they really look at is the amount of money in their bank statement. And this tells you in a summary form what's happening to your bank statement. Now he has all these numbers, and he's done what his SCORE mentor suggested to him, which is to compile his numbers in spreadsheets so that they're more useful. Now he's going to move on to the next step of the process. The mentor suggested he look at key performance indicators. Ashley.
Yep. All right. So what are key performance indicators? Financial key performance indicators, or KPIs, are used by management accountants, financial analysts, bankers, and others to compare one business to another or to assess the health of a business. They usually include calculations using your business numbers, as you can see in the second column. But many business owners aren't using KPIs to self-assess the performance or health of their business, but you really should be. So Bob's SCORE mentor suggested he try using them to assess his own business, and Bob selected the items you see in the right column, or left column for you guys. And those are year-over-year change in sales, sales per square foot, gross profit percent, expenses percent, accounts receivable days outstanding, inventory turnover, current ratio, debt to worth ratio, and gross margin return on investment. There are dozens of KPIs that you can use, so pick ones that apply to your specific business. For example, Bob chose inventory turnover and gross margin return on inventory because he owns a retail business which requires inventory management. Next, okay. KPIs can be even more useful to a business if they can be compared to an industry standard. By searching the internet, Bob identified the numbers in the second column to use as benchmarks. These numbers are the median for the industry, meaning that half of businesses fall below the benchmark and half above. And the desired trend column will be applied when comparing business numbers over a period of time. You'll see this later on. You may be able to find free KPIs for your industry online. Also, trade organizations and magazines can be a good resource. There are also profiles out there that you can purchase. If you're looking for KPIs for retail, you might check out the Retail Institute, as they offer a wide range of profiles at no charge, or look to BizMiner, where they sell business profiles for a lower fee. All right, so using ABC Company's key data produced from the Excel spreadsheet tables, Bob was able to identify the key data he needed for his KPI calculations. You'll see that in this chart here. So take a minute and scan down the list. Take note that in order to complete this chart, Bob had to take time to dig out his credit sales numbers from his detailed records, since they were not shown on his income statement. In his case, credit sales are mostly sales paid by credit card, but this took an extra effort. He also had to find records that showed his store occupied 4,000 square feet. It's likely for all of your businesses that these numbers won't be in just one place. So here are the end results for Bob's KPI calculations that you saw earlier. Take a minute to look at the chart. Hopefully you can see that once you have collected your business numbers, it becomes easy to do the calculations for periods of time. This could be your current period, or using numbers to forecast for future periods. It's all about having the right numbers to plug into your spreadsheet, and finding those numbers and making sure they're correct is really the time-consuming part.
So Bob had calculated his key performance indicators. He did them by year for the 4 years he's been in business. And he summarized them in 2 spreadsheets, because that's a handy way to store information. And this spreadsheet shows the trends in the numbers. He was looking at trends. Has the trend in his business KPIs indicated that his business is healthy, that it's growing, that its finances are in order? And as you can see, I used a green, or Bob used green and red to indicate, green indicating trends that were positive to the health indication of the future of the business, and red for those that weren't. As you can see at the top, sales, net change in sales at 11 or 10% is very positive. The trend is upwards. His sales per square foot, which is revenue divided by the 4,000 square feet, are trending upwards in the 4 years that he's been in business. His gross profit percent at around 50-51% has basically been the same, and it's either trended upward or positive. At least it's not declining, because when it starts declining, that's indicative of problems, because sooner or later the bills won't be paid. The expenses percent, as we had talked earlier, went up. That's a negative trend for the business, but Bob was very happy to have it be negative, because he put most of that money in his pocket, which is why he owns a business. But nevertheless, you can't have that go on forever, and it is a negative indicator. However, it's not too bad, so that is not such a good thing for the business, but not bad. Accounts receivable days outstanding, frankly, I included that for those of you who might not be retail businesses, because most retail businesses don't carry much in the way of accounts receivable. But for those of you who bill customers on credit, it is an important one. In Bob's case, all he's really looking at is a few days worth of settlement from his credit card account merchant. processing system. He probably has 3 or 4 days worth of sales outstanding at the end of any month. So that trend was negative because it was going up, but it's almost inconsequential for the business. Inventory turnover, we've already talked about, Bob, but it went up in 2019 because Bob made a off the top of his head decision to cut back on inventory buying. Now he's got a new way to look at that, several ways to look at that actually. The current ratio declined, which generally speaking is not good for a business, but he has so little long-term debt, as is indicated in the next line down, and he's really current with his bills. This is really, although a negative trend, not something that threatens the survival of his business. The gross margin return on investment, and some people might not be familiar with that term. What that indicates is that in 2019, he could expect for every dollar he had in inventory, he could earn $2.42 worth of gross profit. It's a very useful indicator for business, for retail businesses especially. So based upon this, and you're looking at these things along with me and Bob, would they indicate that Bob's ABC store was in trouble already before the COVID crisis? No, Bob concluded no. And Bob concluded from this is based upon the trends, his business is strong enough to want to fight through the COVID-19 and survive so that he can thrive in another day. Bob looked at the KPIs in another way. He compared them to the benchmarks. And as you can see from this chart, I also used green and red to indicate comparison to the benchmarks. There really is no benchmark for year-over-year change in sales, but as long as you're growing, it's positive. Growing at least better than the current rate of the consumer price index, which is pretty low right now. Sales per square foot, he's under the benchmark, which indicates either he's underperforming, or since he's a new store, it really indicates that he's got lots of room for growth. And he should be able to achieve, if he returns to health, that benchmark and surpass it. As a matter of fact, while he was researching this, he found out one of his large chain competitors, who has bigger stores in better locations, but still they're achieving $464 per square foot. So even if he achieves the $200 a square foot, Bob is saying to himself, my sales will be $800,000 a year. I can live quite nicely off of that. That's a good indicator. Gross profit, he's above the median, and it's holding its own. So that's a good indicator. His expenses are actually slightly under the median, so that's a positive indicator, even though when you look at the trend, they went up, but it's still under the benchmark. Accounts payable receive outstanding, we can skip over. We've already talked about inventory turnover. Bob has been thinking of that. He read a couple of articles, and one of those articles is going to become very useful in a while, and it's called Buy Forward, which is to make your inventory buying decisions not off the cuff, but on the basis of forecasts of future sales so that you don't overstock. Of course, there's many other issues in buying inventory because you have to buy the right inventory, but you don't want to buy too little of it and too much of it. Current ratio is way over the benchmark, very positive sign. Debt to worth ratio is way under a very positive sign. And the gross margin return on investment comes back to the inventory question. So you're looking at these, I'm looking at these, and Bob looked at them. What was Bob's conclusion? These indicate that his business is pretty healthy, and if he can survive COVID-19, he will be in good shape, and he can grow and thrive in the future. I suggest to you that you put your numbers together, however you do it. I've suggested putting them in spreadsheets, but however you do it, select some key performance indicators or financial ratios pertinent to your business and take a look at them, because they can help you decide whether your business is strong enough to save or not. If your business is already in trouble, was already in trouble before COVID-19, you may have to conclude that it's not going to be worth the struggle. And this is a very hard decision for anybody to make, I know, but it needs to be made because there comes a time when it's better to quit than keep going. And there's another day, and many of our famous entrepreneurs are on their third or fourth business before they succeed. So there's no point in banging your head against the wall when it's not going to do you any good. Survive to fight another day. Well, okay, so Bob has all of this information, and it's all historical so far. But what we're here to do is to talk about the future. How does all this pertain to the future? And this is how it's going to pertain to the future. Bob is going to put together a forecast of the future. We'll talk in a second about how he's going to do it. And he's going to follow this process. He's going to use scenarios as a planning tool. Scenarios are based upon projecting changes to the current operation into the future to see whether the impact it has on the business helps the business or not. And how do you do a scenario? You have to forecast the future. And so right now, Bob was thinking about all this stuff at the end of June. It's now already in July, and time is flying. So he needs to put together something that'll help him make decisions in the future. How can he survive? Because he's decided he's going to survive to thrive. So he will use scenario planning, and in order to do it, he needs a financial forecast. So how he's going to put together the financial forecast? Well, he already has the basis for a forecast of 12 months worth of income statements, 12 months worth of balance sheet, and the resulting cash flow. What is that? It's his 2019 summaries. And in Excel, it's very easy to copy those three things into a new spreadsheet and simply relabel them as 2020. So now you have 2020 looking as if it would be exactly the same as 2019. But of course, that's not the way it's going to be. So the next thing he did, having these spreadsheets, he went into the spreadsheets. This shows the income statement at the top and the balance sheet at the bottom, sort of to compress time a little bit. And he changed the months that were in the 2019 spreadsheets into the actual numbers that he already had for the first 5 months of 2020. And he did that for the balance sheet as well. So now he had a set of spreadsheets that was sort of a hybrid set of spreadsheets. It was showing history for 5 months, 2020, and history for 7 months of 2019. So what he needed to do from that point, oh, and also I go past this, from that starting point, he was able to calculate the cash flow statement for the actual numbers for 2017. And notice what happened to his nearly $81,000 in cash already. He only had $27,000 in cash at the end of May. So the next step for him was to turn that hybrid forecast, which it was sort of a mixture of old numbers and new numbers, into new numbers. And to do that, he went back into that 2019 spreadsheet and he put a forecast of numbers in place of the actual numbers that were in for 2019. The mechanics were all there. And actually, as he did, he could really look down the spreadsheet and say, you know what? Payroll isn't going to be payroll unless I do something different, is not going to be any different from what it was in 2019. I'll just leave that number alone. That's my forecast, the same as 2019. It gives you some very good clues as to what the numbers are. You're not, when you have history, you don't have to pull them out of the blue sky. You have something to go by. So now he has a forecast for 2019, and this is his scenario one. There was one other factor that he put into, and I didn't show the balance sheet and income statement because you can get the idea of what he did. But there was one other thing he cranked into his forecast balance sheet, and that was the fact that in May, like many He applied for a PPP loan and he got a PPP loan of nearly $30,000. And he cranked that into his forecast balance sheet, remembering that cash flow encompasses the activities represented by the income statement and the activities represented by the coming and going of cash through accounts receivable, inventory, bank loans, and so on. He cranked that in, and now he had scenario one. Bob used Excel's graphing function to depict what scenario one would look like. And the purple line that you see, the one that goes off the chart at the right, is the balance, cash balance that would be in his bank account at the end of each month with that scenario that he just produced, scenario one. It indicated that if he didn't change anything, actually he was hoping that the PPP loan would get him through and he wouldn't have to change anything. He wouldn't have to lay anybody off. He wouldn't have to stop paying himself. Maybe he'd have to tweak some expenses a little bit, but he was hoping that would get him through. Not so. If the sales forecast that he had looked at showed that he wouldn't return until about 80% of normalcy by December, he was going to be in real trouble. He was going to be out of cash by the end of June, actually probably already was closed out by the end of July. This was a no-go scenario. He had to do something else. So Bob went back and he said, I have to do something else. There's one thing I know about this. I cannot control customer behavior. I can encourage them to come to my store, but there's nothing I can do to make them come to my store. A buyer has to want my product. He has to be willing to come to my store to buy it, and he has to have the wherewithal to pay for it. And right now, two of those three things are missing, and Bob has no control over that. He may have what they need, what they want, but they don't want to come to a store to buy it, and they don't have the cash because they're now unemployed anyways. So it's the expenses that he has to take a look at and not revenue. So Bob had to dig into the numbers. What expenses am I going to cut to? This chart goes back to the 2019. I'm sorry I didn't put labels at the top, but these are showing the last 3 months of expenses in 2019, and the right-hand column is the total for the year. His accounting records only has one line item in it, advertising and promotion. But when you dig into it, which he had to do, he had to go back and look at the accounting records, actually had to go look back at his bank statements. And what was in the $1,800 that I spent in the month of October in 2019? Turns out it was $1,100 worth of newspaper advertising, $275 he's paying to a media consultant. I don't know, maybe Ashley is receiving that. I hope so.
Me too.
It would be good. Ashley runs sort of that business, inside joke. At any rate, so what he had to do is do a lot more research. Now you could say, boy, it looks like a lot of work. Well, yes, it is a lot of work. What's the most important asset in your life besides your house and your family? It's your business. It's worth the work. So he dug into the numbers, and this enabled to look at these things and say, well, okay, one thing is obvious. I don't even have to dig into the numbers. The payroll has got to go. I got to stop paying myself. And not only that, it looks like I have 2 full-time and 1 part-time people. One of the part-timer has to go, and one of the full-time people has to go. I've got to lay those people off, and I've got to stop paying myself. That's a big chunk of overhead gone. But now I can look at some of the other things. I can tweak the numbers for advertising. I can say, I've been placing 2 ads in the newspaper a month, costing me $1,110. Maybe I'll only do 1 ad a month. He is making some decisions when he does that, though. And I want to point out here at this point that he's making 2 very important decisions. One is that he's decided he will not discount his goods to try to bring customers in who aren't going to come anyways. He's got very high gross profit margins. It's above the median, and it's the source of the fact that his business has been so profitable. if he cuts prices, it will hurt his ability to survive in the future, because the people who came in and bought that fancy silk t-shirt that I talked about, there was a couple of local physicians who like to wear them under their suit coats and paid $80 a piece for them. When they come back and find out he's selling them for $50, they'll never pay $50, $80 again. He'd be cutting his own throat. That's an important decision for a retail store or any business to make. And the second one is, he's not going to stop advertising at all. He would rather not pay himself and lay people off than he would to get rid of advertising, because he needs to keep those people out there aware that he's still here and he still has products they need, even if they can't come today to buy them. Two key important decisions. At any rate, he made a bunch of changes in his forecast, and now he has scenario 2. Scenario 2 was make some cuts. I should make at the bottom the point that once he decided not to cut the payroll, he pretty much gave up the possibility of getting loan forgiveness. And he didn't really want to take on more debt, but he's decided that that's a pretty good loan deal, and he'd rather spend the money keeping the business alive and not paying people that he didn't need anyways, including himself, that he could live without the pay. But as you can see, the purple line from this, scenario 2 looked better. He was scraping along zero. Some of that, he would have to make up those deficits somewhere. Perhaps he could get away with scenario 2. Maybe he hadn't really looked at stretching accounts payable, talking to his vendors, although he was cutting back in inventory. But it's really too risky at this point. So what he needed to do was look at some other changes. And so that brought him to scenario 3. And what he did for scenario 3 was he went to his landlord and he asked for a month's forgiveness on rent. And he asked the landlord to roll back the rent increase, because his lease provided for an annual rent increase of about 2 or 3%, very typical of retail lease agreements. The landlord even implied or hinted that he'd be willing to forego another month, but he would expect to be paid back in the future. He went to his family, who were the angel investors who loaned him $100,000 to get the business started, and said, folks, I can't make the principal payments like we agreed, but if you'll agree to interest-only payments, I will return to health someday and you'll get your money, the rest of your money back. They agreed to that. He went by and he looked at this expense, that other expense. He's going to take some fluorescent bulbs out of his lighting. He's going to turn the thermostat back a little bit, cut his electric bill. I mean, lots of little itty-bitty things. But he is not going to make desperate cuts. He's going to make intelligent cuts. And notice that what we're talking about are cuts in the future. If he gets to September and sales have restored, he doesn't have to make those cuts. On the other hand, if he gets to August and the sales are not materializing, he may have to make more cuts, which means in August, late August, it's now late July, late August, he is going to do another scenario evaluation by tweaking the numbers in his forecast. So this is really the conclusion of the presentation. To sum things up, the point of this exercise, or the point of this webinar, is to tell you, or to suggest to you, that Microsoft Excel is a valuable business tool, and it would be a good idea if you learned how to use it. It's useful not only for looking at financial numbers, it's also useful for a whole nother topic that we didn't get into, which is, for instance, statistics having to do with your marketing program, conversion rate, which is, I have a whole list here of other marketing related KPIs having to do with retail businesses. Microsoft Excel is the way to analyze those. If you want to look into the future, look into the past, because the past comes from the future. Organize your history in spreadsheets so you can manipulate them and use them. Use KPIs and benchmarks to assess the health of your business now, and as you go forward, continue to use them so that you can say, I now have a way of looking at whether I'm making good inventory buying decisions or not, based on finances. Won't help you if you buy the wrong color of a shirt to sell, but it will help you decide how much you should buy. Use those KPIs and benchmarks now to decide, is my business not so healthy now that struggling isn't worth it? Or looking at it saying, my business can survive, it's in good enough health, and I should do what I need to take to make it survive. If it's to survive and later to thrive, look for patterns and possible changes and test them, future result in scenario analysis. And finally, ask for help. Ask your accountant, ask your lawyer, ask your father, ask your brother, ask your neighbor, even ask your competitors. And of course, we hope you will ask SCORE mentors. You'll see at the end a list of the 8 offices or chapters that SCORE has in the Southwest Florida region, and you can ask any one of them for help. Bob could do it, imaginary Bob. You can do the same thing too. And a final comment, I suggest you learn how to use Microsoft Excel. This book you're looking at now is an excellent tool to learn it. Actually, I've been doing spreadsheet analysis since the first spreadsheet I did on paper was in 1968, and it's come a long way, and it's electronic now. I looked at this book and I 3 or 4 years ago and see if there were a few things that I didn't know, and I picked up some tips in it. I like it because it's got an online set of spreadsheets that you can use to follow along with the words in the book, how to do this, how to do that. I don't get any royalties from this. I never met the lady, so don't think that. I'm not peddling the book, but I think it's useful. It's about 160 pages long. All you need to know is in the first 40 or 50 pages. It's a great resource. And here are some other resources. You can go to the SCORE website. There are a whole bunch of resources on there. Included in those resources, and I looked at those for this webinar actually about 2 weeks ago, in connection with Constant Contact, SCORE has a whole bunch of little, call them booklets, that are pertinent to reopening your business in COVID, set up for different industries. The SBA, this particular link is about funding programs, but there's also a host of other information about managing a business. The CDC website has stuff on it about how to open your business so that it's such that customers will want to come in and they'll be safe for them to come in. And when it comes to the numbers in the spreadsheets, and I hope that I don't get a lot of inquiries, but if you can't find help with the process that I just described it elsewhere, send an email to portcharlotte@scorevolunteer.org, and in the subject line, write my name, first name Henry, or Henry need help, and I will get back to you. If there are a lot of inquiries, it may take me a while. I'll take them one at a time. And so that was our 45 minutes. From this point on, we are going to answer questions. I'm going to start by answering 4 questions, if I can find them, that came in with the registration. So the first question was, how do I get a federal tax lien resolved? Well, SCORE doesn't give specific tax advice on an issue like that. I wish I could, but I can't. And actually, I don't know the answer anyways. What you need to do is find an accountant or a lawyer that deals in those issues. The 6th webinar in this is going to be presented by an attorney, and I believe he may address the answer to that question. So you might want to attend that one. The second question was, how is an SBA score calculated, or a financial picture as it pertains to lending? I'm not quite sure what the question is aimed at. I'm going to assume it's aimed at obtaining a loan from SCORE other than the economic injury disaster loan. And it's probably has to do with getting an SBA loan. Well, other than the economic injury disaster loan, actually the SBA does not make loans. What they do is they guarantee loans made by banks. And it is the banks that make the evaluation as to whether an applicant's application for borrowing is suitable. They do it on a variety of information. They look at the individual's credit score. They're looking for 640 to 680. They look at the individual's personal finances. They want your balance sheet, your income statement, your personal income statement, your personal balance sheet. And they also look at the finances of the business. The first criteria is that SBA doesn't guarantee loans to businesses that have not been in business for at least 2 years. So it's a complicated thing. If you want more information, I'll be happy to explain it. Write me email to portcharlottescorevolunteer.org, and I will try to get back to you about that. Another question was, show me as a freelancer how to carry over through no income stretches. Well, I wish I had the magic answer to that. As I just talked about lending, banks don't lend money to businesses that have big gaps in their cash flow. So what you're really asking should be addressed as a marketing question. If you have gaps in your income, then you need to expand your outreach to try to find different kinds of customers that can use your service, or to add to your bag of tricks different services that your present customers can use. And if that doesn't work, then you may have to get a part-time job. And I have to give the final answer. It's the one I've been doing this score mentoring for years, and it's the one I always hate to give, but I have to give it. If within a reasonable period of time, your business is not producing a steady revenue stream, it is time to think about whether it's worth continuing to go forward. A final question came in. How do you calculate the break-even point during the uncertain end of COVID-19? And how much extra working capital is required? I hope that I've answered that question in the previous 45 minutes. By collecting your historical information, by projecting into the future, you can answer that question. In a sense, the break-even point is the point at which the gross profit from your sales equals your overhead expenses. And both of those are variables, and you need to really, if you're looking to the future, you need to go through the sort of process that I just described. Okay, any other questions?
Yes, great job, Henry. Thank you so much. One person asked, given that this is, the example used throughout was a for-profit organization, is your information that you provided today applicable for nonprofit organizations, and in what manner?
Absolutely, it's exactly the same. People somehow seem to think that nonprofits are something different what they are. Nonprofits are business entities, and the only thing that nonprofit business entity can't do that a for-profit one is to give out cash to the owners of the entity. Otherwise, they're a business operation. They have customers or clients. They actually have dual marketing programs, more tricky than for-profit businesses because they must raise money from fundraisers, their funding sources, which is one marketing program, and they must bring in clients for their services, which is another marketing program. But the process I'm talking about gathering your historical information, the names on the financial statements are different. We have statements of activity and statements of financial position, but those are essentially profit and loss statements. You gather up the information, and then you can use scenario analysis to do the very same thing.
All right, great. I am a small business owner and the sole employee. Should I obtain an EIN for my business, and should I file for an LLC?
Those are a little outside the thing of this, but Whether you should file as an LLC or not depends upon the nature of your business, but I can summarize it this way. If you do not want to be personally responsible for every debt that the business incurs, and if you do not want to be personally responsible for every claim that an injured party might make because of something the business did, you should form a legal entity, either a corporation or a limited liability company. The second answer is if you form a limited liability company, you will need to get an EIN. If you're going to stay as a proprietor, you do not have to get an EIN unless you're going to hire employees, because you do need an EIN if you have employees. But I suggest to proprietors that if you do not, if every time somebody wants to, I'll back up, you can do business using your personal Social Security number as a proprietor. But you'll get faced with the question of somebody saying, I want to send you a 1099, please give me the business number you do. And if you're operating under your Social Security number, you have to hand out your Social Security number. Much better to have an EIN number and protect your Social Security number.
Okay. Somebody writes, probably not one of my wiser decisions, but I am out of work and am an older worker on Social Security, thinking about starting a consulting LLC to keep me active. I know the money may not flow in anytime soon, but do see business down the road. Not looking to make $1 million. I will be working from my home, so not much to buy. I can afford the startup expenses. I was told to watch my initial expenses. Any other suggestions?
Well, certainly there's no reason, there's businesses being formed all the time. And in SCORE, we're getting inquiries from businesses that are wanting to form. They are forming. There's always opportunity out in the world. So yes, what you do, but I suggest what you do is formalize your thinking process by doing some sort of a business plan. I suggest you stick around for the session after the next, which is going to use a business planning tool called a business model canvas. I suggest you attend that seminar and look at that's only 2 weeks away, and look at the process of business planning as it's displayed through that. And you can put up a wall chart in the wall of your house and think through your business idea through this business planning process. And of course, I'm not sure where you are, but there are SCORE mentors aplenty who would help you with the process. Watch your pennies, make a financial projection, and have at it. And good luck.
Thank you. So the next 3 questions are all from the same entrepreneur who has a small nail and skincare business with no employees. Mm-hmm. So the 3 questions are, do I need to keep this type of record keeping? Is there anything besides Excel that will determine the KPIs automatically? And how do I get financial help with starting my business in a brick and mortar facility?
Well, all businesses should keep financial records. And actually, the QuickBooks is the tool that everybody knows, so you use QuickBooks. You can set up QuickBooks. Actually, I have plans to have a Zoom meeting with a lady in Texas Monday or Tuesday, in which I'm going to look at her screen like you're looking at my question and answer picture, and we're going to work our way through setting up her QuickBooks records. Absolutely, you need historical financial records. I further suggest that you assemble them as you go. It's a lot easier to do it as you go, to assemble them in the spreadsheets that I'm talking about, because Excel may be good at collecting the numbers in accounting record, but it's not great at displaying them in a form that allows you to use them to make decisions about the future. Joe, I don't know, I lost the other track of the other 2.
The other 2 were, so is Excel the only tool that will determine automatically the KPI indicators?
Well, it doesn't determine them automatically. You have to set up the formulas to do it. But believe me, all that jumble of numbers looks like it's horrible to begin with, but basically once you get down to it, it's like filling out a bingo card. Basically, you put a number in a square, and there are formulas that'll help you add them together, but you have to create the formulas.
Okay. And then
You could, by the way, I'll say, you could use paper and pencil if you wanted an adding machine or a calculator to do this. You don't have to follow this process. But once you automate it, it's easier to keep it up to date. And where do you get help? Call SCORE.
I'll add to that too that there are other spreadsheet programs. If you're using a computer like a Mac, they have a program called Numbers. From my experience as a Mac user, I find that using Microsoft programs when doing business financials is a lot easier. So I agree with Bill here, or Henry here, that this is a program you're going to want to use Excel for.
Okay. You don't necessarily even have to have Excel, because if you are a Google Chrome user, they have the equivalent. They call it Google Sheets, I guess is what they call them.
Right.
I prefer to use Excel, but yeah.
Okay. Another question is regarding laying off people. How will laying off people or lowering payroll affect the PPP loan that he just received?
Well, the forgiveness on the PPP loan, of course, this keeps shifting like sands on the beach when the water is running under your feet. But forgiveness on the PPP loan is basically predicated on your spending 75% of the amount of the loan on payroll over a given period. They keep changing the given period. It started off as 8 weeks. I understand it's up to 27 weeks. If you don't spend 75% of the money on payroll, like Bob decided not to do that, then the loan won't be forgiven. However, it's not the end of the world. The loan carries an interest rate of 1%. You'll never find a loan like that anywhere. You don't have to start making payments for 6 months. And I believe the loan period was 2 years. It may be as high as 5 years now. So, okay. But if you don't spend the money, 75% of the money on payroll, you won't get it forgiven.
All right, thank you. Another question with regards to data. Is QuickBooks data saved as an Excel spreadsheet a good start for these projections?
Sure.
Okay.
If it saves it in the format that you're talking about, yes.
Okay. PPP and idle loans or other non-sales income, what line would you put them in on your forecasts?
Aha, very tricky question. And I'm going to refer you to a tax expert because this is quite tricky. First, start with the EIDL loan. If you got an EIDL advance, which is different from the loan, the advance is stated to be a loan, but is it a loan that's going to be forgiven? And under our tax laws, the principal balance of a loan that's forgiven is considered to be income for the borrower. However, through the magic of legislation, somehow Congress made that go away, so that the economic disaster loan will be treated as a grant, except for they don't call it as a grant, because if you receive a grant, that's income. So I'm not quite sure where you'd put it. I think you have to consult an accountant. If I were doing it, probably if I was still running a business, I would avoid calling it income, and I would avoid calling it a loan. I'd probably put it directly into equity, but I don't know. Consult an accountant who knows what he's doing. And the same thing is true of the PPP loan. A loan forgiven, if the PPP loan is forgiven, then according to our tax law, it becomes income. But Congress has magically made that go away. So you have the same accounting question with regard to the PPP loan. If you don't apply for forgiveness, then it becomes a loan. In the case of the second part of the EIDL loan, that is a loan, and you put it on your balance sheet as a loan, and you distribute the payments between principal and interest. There's a trickier part that I'll finish off on that. Our tax laws also say that if you get one tax benefit, you can't use that benefit as a second tax benefit. And how that works is that if you spend PPP loan money on payroll, you cannot deduct that payroll as an expense on your taxes, because otherwise you would be double dipping. This is very confusing, very tricky. Consult a tax professional on this.
Okay, great. So two people have come forward with more information regarding safe harbors for the reduction in full-time employees. I guess there's now 3 safe harbors with regards to the PPP loan program, and the Minnesota SCORE chapter had a webinar on that earlier this week. And the 75% of the loan being put towards payroll has changed to 60%.
Okay. Yeah.
So thank you for those
I've
updates.
stopped keeping track of that when I stopped getting inquiries a few weeks ago.
Right.
Also, I will mention to those folks that that webinar was probably recorded. They can get it from the Minnesota chapter.
Exactly.
Also, the Small Business Administration is having almost weekly webinars on this very same issue. So if you can't find the one, you can find the other.
Yes. So there's one question here, and I believe that's the, well, we have 2 more questions. Where can I get more information on the advertising marketing performance ratio statistics you mentioned?
Well, the website that retail owner, you have to flip back to it. That website is a fantastic one. Every retail store owner should be on that, looking at that website. They do wonderful webinars. I watch them. They have a lot of data on this thing. If you go there, you might find retail ones. Sales per employee is a common one. I found it's very hard to find benchmarks. Conversion rate. In order to calculate the conversion rate, you need to know the number of visitors in your store, which means you got to have a way to collect it. I ran a small retail operation because I started running a business. I owned a printing business, but I started it as a copy shop. And I had just a piece of paper, a pad of papers, which I printed up, of course. And every time somebody came in the shop, I put a check mark. It was as simple as that. Now, mine was a small business. Yours is a large one. You may need a counter on the front door. But that is your sales, your revenue divided by the number of visitors, or sorry, the number of sales you have, transactions you have, divided by the number of visitors. That's a conversion rate. Average transaction, which is your revenue divided by the number of transactions. The average number of items in each transaction. Point of sales systems typically will provide this. The average revenue per item. You need to know the number of items in your total revenue. The sell-through number, which is a little tricky number. It's the number of units sold divided by your beginning inventory times 100. It's showing you how fast a particular item moves through your thing. If you go to that retail owner's website and others, there are I don't know what business you're in. The convenience store industry has an excellent trade association that has an annual report. It costs you $850 to buy it, but it's loaded with data. So scrounge around on the internet, but for retail stores, retailowner.com.
So 2 last questions, and we probably should put up the slide with all of the chapter information.
Yes.
The first of the last 2 questions are, for a consulting situation, should I mix my Social Security with my business income? There you go, thank you. Should
Absolutely.
I mix? Yes.
Ask that again. Mixing personal income with business income?
Well, Social Security, yes, with my business income.
Well, the answer is no. You should keep a separate bank account for your business income. so
Great.
that all cash that comes into the business and all cash that goes out of the business goes through that and not through the personal income.
Great.
If you need to file, I'm not sure what the legal form of your business is, but if you're operating as a proprietor, you need to file a Schedule C with your personal income tax return. It's a report on the business profit and loss, and you need to pay taxes on that.
Great. Last question. Will QuickBooks be helpful in automating all of the spreadsheets in this session?
Well, my preference is to take the numbers out and enter them into spreadsheets. However, if your QuickBooks have a way to export the numbers by month in a spreadsheet, fine. I just looked, I also happen to be the treasurer for the SCORE office that I'm in, and I just looked at our accounting system, and it has a report which shows the month by month income and expenditures. And it's downloadable in Excel spreadsheet format. So if you've got a tool like that, it certainly helps to automate the process.
Great. And that's it. Those were all the questions. Thank you,
Well,
Henry.
for all of those that you're still on and those of you who are left, thank you for attending. I hope this was worth it. Find a local mentor. We're out here. We want to help. And we hope to hear from you. And we still have 62 people on, I guess, but I'll stop the sharing. And are people signing off now, or are there other questions?
They're slowly signing off.
Okay.